One of the biggest concerns investors have is that inflation could skyrocket within several years, given the vast amounts of money being printed by major central banks around the world. Many investors are worried about how they're going to shield their portfolio from rising prices so they can continue to enjoy real returns. Well, one way to protect the portfolio, according to Intech's General Manager of Investments, Daniel Needham, is by investing in global inflation-linked bonds. He joins us in the studio today to talk about this relatively unknown asset class. Daniel, thank you for joining us.
Thanks, Vishal. Excited to be here to talk about inflation-linked bonds.
So, Daniel, what are global inflation-linked bonds and how do they differ from your plain vanilla bonds?
Inflation-linked bonds are bonds that have their coupon and principals adjusted for inflation. And so if you have a coupon that is paid every 6 months, that coupon will be increased for the amount of inflation that occurred on the previous 6 months. They differ in a number of ways to nominal bonds, nominal government bonds. The first is that they have a higher real interest rate sensitivity than nominal bonds. This is due to two reasons. The first reason being they tend to be issued at longer maturities, and secondly, a greater portion of the price of the bond is actually in the future, and therefore small changes in interest rates have a bigger impact on the price of an inflation-linked bond than a nominal bond. They also are issued by governments at smaller sizes, so the market is actually smaller than nominal bonds, and that makes them less liquid, but also well diversified. And another important distinction is that inflation-linked bonds provide a hedge against unexpectedly high inflation, whereas nominal bonds provide a hedge against unexpectedly low inflation, like in a recession.
We know governments around the world are issuing a lot of bonds to pay for their spending, but are they issuing a lot of inflation-linked bonds in particular?
Look, there's been a lot of issuance in nominal government bonds, and that's really where the treasuries around the world have been focusing. There has been issuances of inflation-linked bonds, but not to the same degree as nominal government bonds. We've seen the ratio of government bonds to nominal bonds to inflation-linked bonds reduce. So there's been more nominal bonds issued. And that may change because treasuries are having larger and larger budget deficits that need to be financed, and we expect them to probably increase their issuance of inflation-linked bonds.
We're hearing a lot of people talk about inflation, soaring inflation, and even hyperinflation, but we're also hearing from the other side people talk about deflation, given there's a lot of excess capacity in the world and very weak consumer demand still. What effect does either phenomenon have on global inflation-linked bonds?
Well, there's a few points I can cover in that question because it's obviously a very uncertain time, and I think you can get lots of differences in opinion about how those factors are going to affect inflation-linked bonds. We believe that in the short term, the risks are probably skewed to deflation in the sense that there is excess capacity in the developed world, quite significant excess capacity, given the fact that we're in the most synchronised downturn since World War II. So in the short term, there's probably downside risks to prices, but certainly in the medium term we see some upside risks to inflation. In an extremely high inflation environment, global inflation-linked bonds would actually perform better than nominal bonds, especially when there's surprise inflation on the upside. That's where inflation-linked bonds do well. Where they don't do so well is in a deflationary environment where there's inflation surprises to the downside. We believe that we're probably through the worst of that. Now, the issuance by governments will probably be more targeted on areas where they believe they will need to pay a lower interest rate. And so that's an area where we still need to focus on the issuance side.
What's the typical duration of these bonds? If they're longer than normal, does that make them more risky?
It does make them more risky. I mean, it depends on which market you're talking about and also specifically what type of risk measure you're using. But the issuances tend to be at much longer points of the curve, and there tends to be less of them. The duration of the Barclays World Government Inflation-Linked Bond Index is around about 10, whereas if you compare that to, say, the government nominal index of around about 6, so you can see there's considerably more interest rate risk there. Intech has done some research around customising an index to reduce that interest rate sensitivity via targeting the 3 to 10 year part of the curve and building a more diversified portfolio to try and reduce some of those risks.
What place does global inflation-linked bonds have in a client's portfolio, and what exposure does Intech have within its own balanced portfolio?
Well, I think inflation-linked bonds play a very important role for investors in the sense that most investors are trying to target a long-term real return, that is a return above inflation, and inflation-linked bonds by their nature, are a real return instrument. They're designed to give you a real yield plus inflation. So anybody who's trying to achieve a real return target probably should have an exposure to inflation-linked bonds, depending on the valuation that they're trading at the time. So for our portfolio, we've got around about 3% exposure to global inflation-linked bonds, and that will differ depending on what we believe markets are going to do, what we think inflation's going to do, and also how much exposure we have to nominal government bonds. I mean, the biggest risk for nominal government bonds is unexpectedly high inflation, and the biggest benefit of having inflation-linked bonds in your portfolio is it benefits from unexpectedly high inflation. So it's a good hedge to a nominal government bond portfolio.
And so these products are good for retirees?
I think it can be a useful product for retirees, especially retirees who are trying to target an inflation-linked income. So they want to make sure that their retirement income keeps up with changes in prices, so they can buy as much food in 10 years' time as they can buy today, plus a small incremental return. So we believe that as the inflation-linked bond market expands, becomes bigger and more liquid, it'll probably become more important in most people's portfolios. It's still a new asset class and a new area, and we think that we've built a very innovative product and approach to this which we haven't seen in the marketplace anywhere else.
Daniel, thank you for joining me today.
No worries. Thanks, Vishal.